This stock is either quietly fixing itself or setting up for another breakdown. Comtech Telecommunications, ticker CMTL, is trading at roughly $3 as of late March 2026. And what's happening here is not a simple decline story, it's a timing problem wrapped inside a business reset. In this video, we're going to break down what the company actually does, why parts of the business are clearly improving, where the pressure is building, and what kind of investor this setup may actually make sense for. Quick reminder before we go any further, I'm not your financial advisor. This video is for educational and informational purposes only and is not financial advice. Penny stocks and small caps are very risky and you can lose all your money. So always do your own research or talk to a licensed professional before making any decisions. At a high level, Comtech sits inside mission-critical communications, the systems that let militaries, emergency services, and telecom networks actually connect when it matters. They build satellite communication systems, software-defined modems, and next-generation 911 infrastructure. Not consumer-facing tech, but the backbone layer that carries signals when failure isn't an option. And right now, that backbone is being rebuilt. But here's the key tension: they're improving the quality of the business. At the exact same time, their financial structure is putting pressure on the clock. This is what management calls a shrink-tory growth strategy. They're deliberately walking away from lower-margin, hardware-heavy contracts and refocusing on higher-value, software-driven communications platforms. So revenue is going down. But the business underneath is changing. In the most recent quarter, revenue fell to about $106 million from roughly $126 million a year earlier. On the surface, that looks like deterioration. But at the same time, gross margins expanded from around 12% to nearly 34%. The company is essentially trading volume for quality. Fewer contracts, but better ones. Lower top line, but more economic value per dollar of revenue. And this is where the story starts to tighten. Because this isn't just about exiting bad business, it's about rebuilding around a more durable role in communications infrastructure. Part of that comes from operational changes, like consolidating production into a centralized facility to improve efficiency and reduce costs. But that's not the real driver. The real driver is what they're positioning themselves to become. On one side, you have defense modernization. Comtech is supplying software-defined communication systems, including its ADEM modem program with the U.S. Army, a contract worth roughly $48 million. These systems are designed to replace legacy analog hardware with digital, interoperable infrastructure. And importantly, initial units have already been delivered. That matters because it moves the story from concept to execution. It shows they can actually meet the technical requirements of these programs. If this transitions into full-rate production, it becomes more than a contract, it becomes a scaling platform. But that's only half the repositioning. On the other side, you have public safety infrastructure, specifically next-generation 911 systems. This part of the business is already moving toward recurring, software-based revenue. It serves telecom operators and emergency networks, and it's showing modest but steady growth, with improving operating income. There's also a long-term telecom contract worth over $130 million supporting this segment, with meaningful funding already flowing into the program. And this is where the pieces connect. Comtech is trying to reposition itself as a communications infrastructure platform that sits across two critical systems: defense networks that are being digitized, and public safety networks that are becoming software-driven and recurring. That combination, if it works, starts to look less like a declining hardware vendor and more like a higher-quality, infrastructure layer business. But here's the problem. That transformation is happening under time pressure. Because while the business is improving, the capital structure is not forgiving. If you're getting value from this breakdown, tap like and subscribe to Penny Stock Pulse. It really helps the channel and tells me to keep making these deep dives for you. Comtech is carrying over $200 million in debt, with interest rates in the high teens. That creates a constant drag on earnings and limits flexibility. On top of that, there's over $200 million in preferred stocks sitting above common shareholders. So even if the business improves, a large portion of that value doesn't immediately flow to equity. And then there's the third layer, potential dilution. In March 2026, the company filed a shelf registration for up to $125 million in securities. That gives them options to raise capital, but it also creates a real possibility of issuing new shares. And when your market cap is in a similar range, that becomes a central risk, not a side note. This is where the story gets harder. Because now the question isn't just whether the business improves, It's whether it improves fast enough to scale new programs, fast enough to expand margins, fast enough to generate enough cash to offset debt costs and avoid relying on dilution. And here's the line that matters most. If production ramps and recurring revenue don't show up meaningfully over the next 12 to 18 months, the turnaround doesn't stall, it gets overtaken by the capital structure. That's what breaks the thesis. There are also external pressures layered on top of that. A meaningful portion of revenue depends on government spending cycles, and delays, like the recent shutdown impact, can push out orders and compress near-term results. So execution risk here isn't just internal. It's tied to timing, budgets, and program rollout schedules. Now let's step back and look at how the market is pricing this. The stock has been highly volatile, dropping from around $5.50 earlier in the month to near $3, with large daily swings. That kind of price action tells you the market is still trying to find a floor, not valuing this as a stable business, but as a transitional one. At the same time, valuation is extremely compressed, with a price-to-sales ratio around 0.2x. So the market is clearly discounting the turnaround. But here's the key framing. This is no longer priced for stability, but it's also not priced for a successful repositioning. That means the turnaround only creates equity value if it materializes before the balance sheet starts to dictate the outcome. If execution improves and the business starts to look like a higher margin infrastructure-driven platform, there's room for re-rating. If not, the combination of debt, preferred overhang, and dilution risk can continue to weigh on the equity. So who does this actually make sense for? This is likely to appeal to investors who are comfortable with volatility and willing to underwrite a multi-quarter transition. You would need to be comfortable with uneven results, potential dilution, and the possibility that the timeline stretches. And more importantly, you would need to believe that management can execute quickly enough, not just correctly. Because speed is the variable that defines this entire setup. This is not a clean turnaround. It's a race between improving business quality and a heavy capital structure. The bull case is a successful repositioning into a higher margin, defense and public safety communications infrastructure platform. The bear case is that the capital structure absorbs that improvement before it fully reaches equity holders. And what matters next is timing, specifically. Whether production ramps and recurring revenue scale fast enough to change how the market values this business. If you found this deep dive helpful, hit like, subscribe to Penny Stock Pulse, and turn on notifications so you don't miss the next under-the-radar breakdown. Thanks for watching, and I'll see you in the next video.